For a long time, the offer of a company car has been a great incentive to retain and reward hardworking employees. However, in recent years, the rules regarding company cars have changed, making them less appealing to companies and employees, especially given the complexity of the current regulations. So to help, we're going to give you a brief overview of some of the issues that businesses, employees and fleet managers may need to consider when purchasing or leasing a company car. Company car tax, more formally referred to as benefit in kind tax, classes a vehicle as an additional taxable benefit that falls outside of a person's standard salary. Whether you're in a traditional company car scheme or gifted a company car allowance, it's important to know how much tax you can expect to pay. The latest benefit in kind rates for the financial year started on 6th of April 2021 and follow on from rules in the previous tax year, which saw several changes due to the stricter new European WLTP, that's World Harmonised Light Vehicle Test Procedure, emission and economy tests. Emissions are key to the amount of company car tax paid, and the new WLTP tests, which replace the former NEDC or New European Driving Cycle tests, means that most cars on paper will have a higher CO2, carbon dioxide emissions, meaning a higher rate of tax. The Treasury has recognised that the test may unfairly disadvantage some company car users. And so to achieve fairness, the Treasury has reduced the benefit in kind rates used for older NEDC assessed cars registered under the new WLTP system by 2% during the last tax year. This reduction has now fallen to 1% in the 2021-22 financial year and will disappear altogether next year. This means that there will be no reduction in its benefit in kind rate for these vehicles from April 2022. People looking to purchase a new company car in the next year should review the government's latest rules at gov.uk. Be aware, though, that these rates change annually and may differ after April 2022. If businesses and employees review the latest company car tax rates, they should be able to determine which vehicles suit their needs and can reduce their benefit in kind liabilities. However, while diesel engine vehicles may once have been the most tax efficient choice for many companies, these are now subject to new rules. This stipulates that if they do not meet the RDE2, real driving emissions, element of the WLTP tests, they will be subject to a 4% higher benefit in kind rate than petrol cars. Many manufacturers of popular company vehicles are aware of this and are producing models that meet these strict standards, so that it's still possible to take advantage of the reduced tax rates that diesel vehicles incur, thanks to having low CO2 emissions compared to their petrol equivalents. However, with advances in electric and hybrid technology, there may be an even more tax-efficient solution for companies to utilise. There are several tax incentives for both company car users and fleet operators who switch to electric vehicles. With generous financial incentives available, that is why more and more businesses have either already made the switch or are giving serious consideration to doing so. So what financial incentives are available? Well, let's look at benefits in kind. So since April 2021, electric vehicles attract a 1% benefit in kind tax rate. This rate also applies to hybrid vehicles with emissions from 1 to 50 grams per kilometre and a pure electric range of over 130 miles. This rate increases to 2% in 22-23, but it is still making electric and low emission cars very affordable in comparison to higher emission vehicles. Where an electric car is provided under salary sacrifice, the optional remuneration rules do not apply. There are now 11 new tax bands for vehicles with emissions of 75 grams per kilometre and below. The government has also announced the tax rate for the next 3 years, helping businesses to plan ahead. Pure electric vehicles attract zero vehicle excise duty and even avoid the supplement for cars with a price of £40,000 or more, which could save owners and businesses thousands of pounds. Cars with CO2 emissions of less than 50 gram per kilometre are also eligible for 100% first-year capital allowances. This means with electric cars, you can deduct the full cost from your pre-tax profits. Electric vehicles are exempt from congestion charging and clean air zone charges. In addition to London, 5 cities have been mandated by the government to introduce a clean air zone, including Leeds, Birmingham, Nottingham, Derby and Southampton. If your company vehicles travel into areas where clean air zones exist or are about to be introduced, there will be cost savings for your business if you switch to electric. The taxable benefit for having the private use of a zero-emission van were reduced to nil from April 2021, while the previous year electric vans were taxed at 80% of the benefit for a normal van. The government's plug-in car grant provides 35% of the purchase price up to £2,500 towards the cost of an eligible plug-in vehicle costing less than £35,000. The plug-in car grant applies at the time of purchase and is usually given as a discount on the purchase price of a vehicle. Any business that installs charging points for electric vehicles between now and the 31st of March 2023 can claim 100% first-year allowance for these costs. Leasing a vehicle through a VAT-registered company allows you to claim back 50% of the VAT on monthly payments and up to 100% of the VAT on the maintenance agreement, which you are not allowed to do when buying a vehicle outright. Additionally, in some cases, the cost of your lease payments can also be deducted for corporation tax purposes. For leasing, it is the entire lease charges in the year that are deductible, whereas for buying, it is 100% of the net cost of the electric or zero-emission vehicle.